To understand the sheer magnitude of the financial violence witnessed at the end of January 2026, one must first discard the notion that this was a standard market correction. It was not. What the financial world just survived was a coordinated geopolitical ambush masquerading as a volatility event. The history books are already printing the headlines for Silver Thursday 2.0, a moniker that fails to capture the visceral brutality of a month that saw the metal touch 121.64 before losing nearly a third of its value in 48 hours. But before the autopsy of the crash can be performed, before any capital is deployed into the February kill zone, there is a requirement to understand the trap itself. This was not a random fluctuation of supply and demand. This was an engineered liquidity crisis, a sequence of events so precise and so devastating that it separated the institutional architects from the retail casualties with surgical efficiency. To survive the coming weeks, to know whether the current price is a graveyard or the opportunity of a generation, one must look at the evidence. The forensic timeline of January is not just a record of prices. It is a crime scene map. And like all sophisticated crimes, it began long before the alarm started ringing. The narrative of the crash cannot be told without first understanding the silence that preceded it. The month of January must be viewed as a three-act tragedy. And the first act, running from January 1st to January 20th, was the phase of deception. This was the period when fundamentals still appeared to matter, when the price action was disciplined, and when the smartest money in the room was quietly positioning itself for a squeeze that would break the back of the global derivatives market. The year opened with silver trading at approximately $71.59 per ounce, a price that already reflected a 175% gain from the previous year. To the uninitiated, the opening session's 4% pop to $74.51 seemed like standard New Year optimism, a continuation of the previous trend as traders returned from their holiday breaks. But beneath the surface of the futures exchanges, the tectonic plates of the global commodity market had already shifted irrevocably. The catalyst was not in New York or London, but in Beijing, and it arrived with the bureaucratic quietude of a government directive that would change the physics of the market forever. On January 1st, 2026, while Western markets were closed and traders were nursing hangovers, the Ministry of Commerce in China officially implemented a new export control regime that had been quietly telegraphed the previous autumn. In a single administrative stroke, silver was reclassified. No longer was it treated as an ordinary industrial commodity or precious metal for jewelry. It was elevated to the status of a strategic material, placed in the same protected category as rare earth elements, gallium and germanium. The policy was draconian in its specificity. It required exporters to obtain government licenses that were suddenly impossible to secure. The list of qualified exporters was slashed from over 100 entities to a mere 44 state-aligned enterprises. The directive effectively mandated that domestic consumption take absolute priority over global supply, a policy shift that weaponized China's dominance in the refining sector. While the world focused on mining output, few realized that China controlled between 60% and 70% of global silver refining capacity. By choking off the export of refined bars, Beijing was not just securing metal for its own solar photovoltaic sector, which had devoured 29% of global industrial demand by 2024, it was placing a tourniquet on the Western world OS supply lines. The timing of this blockade was unmistakably deliberate. With Washington and Beijing locked in an escalating trade war involving tariffs on advanced technology and critical minerals, the silver export ban was a retaliatory strike on the very infrastructure of the green energy transition. The government in Beijing had no intention of allowing foreign buyers to outbid domestic manufacturers for the material essential to solar panels, electric vehicles, and advanced electronics. The impact on the physical market was immediate and violent. Even if the paper market in New York took days to wake up to the reality, the premium for silver in Shanghai, the amount local buyers pay over the London benchmark, exploded. Historically, this premium hovered between 50 cents and $1 per ounce. By mid-January, it had widened to a staggering $5 to $8, a dislocation that signaled the total breakdown of arbitrage. In a functioning market, traders would buy metal in London and ship it to Shanghai to capture the profit, closing the gap. But with export licenses frozen and inventory hoarded, the arbitrage mechanism shattered. The East was effectively decoupling from the West, creating a vacuum that would suck every available ounce of physical metal out of Western vaults. This geopolitical strangulation triggered a run on the COMEX warehouses in New York that was unprecedented in modern history. During the first week of January alone, the COMEX experienced a withdrawal of 33.45 million ounces in just 7 trading days. To put this into perspective, more than a quarter of the entire registered inventory, the metal available for immediate delivery against futures contracts, vanished in a single week. On Wednesday, January 7th, the data showed a withdrawal of 3.25 million ounces, with absolutely 0 ounces deposited, a terrifying pattern of attrition that had been accelerating since the previous October. By the middle of the month, COMEX registered inventory had plummeted to approximately 108 million ounces, a 50-year low that left the exchange dangerously exposed. The paper market was leveraging itself into oblivion against a physical stockpile that was rapidly disappearing. Open interest for the March 2026 delivery month stood at over 100,000 contracts, representing claims on 500 million ounces of silver. The arithmetic of the squeeze was simple and terrifying. There were 378 paper claims for every single physical ounce sitting in the COMEX vaults. The behavior of the bullion banks during this period provided the smoking gun that this was a structural crisis rather than a speculative bubble. J.P. Morgan, an institution historically known for shorting the metal or accumulating it quietly, issued delivery notices for 8.1 million ounces through 1,924 contracts on January 7th alone, accounting for 99% of that day's activity. This was not the behavior of a bank hedging its bets. It was the behavior of an entity securing physical possession at any cost. A backward rolling pattern emerged in the futures curves, where traders were aggressively rolling positions from forward months back to January and February for immediate delivery. They were willing to pay a premium to get their hands on the metal now, rather than risking a wait for March. This signaled that the industrial and institutional buyers knew exactly what was happening in China. They understood that the global silver market, having run a deficit for 5 consecutive years with an 820 million ounce shortfall, was now facing a 2026 deficit of 200 million ounces without the safety valve of Asian refined supply. The Western world was on its own, and the vaults were running dry. During this first act, the price action remained deceptively orderly. The rally was driven by genuine supply and demand fundamentals, not yet tainted by the madness of the crowd. From January 1st to the 5th, the price consolidated the previous year's gains in the $71 to $77 range. From January 6th to the 12th, as the COMEX withdrawals accelerated, the price broke out into the $80 to $84 band. By mid-month, silver was testing all-time high territory, hitting 93.75 on January 14th, before pulling back to $90 when President Donald Trump delayed a decision on critical mineral tariffs, triggering a brief wave of profit-taking. By January 20th, the market had stabilized near $95, entering a consolidation phase. The gold-silver ratio, a key indicator of market sentiment, compressed from 60.1 to 58.1, signaling that silver was outperforming gold but had not yet entered bubble territory. This was the phase of the smart money. Institutional allocators, aware of the supply chain fracture, were building positions with discipline. They were buying because the physical metal was disappearing, not because a chart on social media told them to. But as the calendar turned to January 21st, the discipline began to fracture. The fundamentals had lit the fire, but the fuel of speculation was about to be poured onto the flames, marking the transition from a rational bull market to a historic mania. If Act 1 was a masterclass in supply chain economics, Act 2 was a descent into psychological madness. Between January 21st and January 29th, the silver market ceased to be a mechanism for price discovery and transformed into a theater of hysteria. The rally transitioned from a fundamentally driven bull market into a speculative mania, characterized by parabolic price action, extreme positioning, and the classic blinding signs of exhaustion that precede every historic collapse. In just 8 trading sessions, the metal added $26 to its price, with the steepest gains concentrated in a frantic final 5-day window that defied all conventional financial gravity. On January 23rd, silver shattered the psychological glass ceiling of $100 per ounce for the first time in history. The breach of this triple-digit threshold was not merely a technical milestone, it was a behavioral trigger. It woke the algorithms. It captured the headlines, and it sucked in a wave of retail capital that was desperate to chase a train that had already left the station. The move from $90 to $100 had taken 10 days of grinding upward pressure. The jump from 100 to 110 took only a single trading session, a velocity that underscored the terrifying intensity of the buying panic. By January 26th, the market was displaying the kind of technical signals that usually scream for caution, but in the heat of the moment, they were interpreted as validation. Silver tested $117.69 intraday, printing a daily candle known as a shooting star, a long upper wick signaling rejection at higher prices and a potential reversal. Technical analysts screamed into the void that the metal was trading more than 100% above its 200-day moving average, a level of overextension that exceeded even the infamous 2011 bubble. But rationality had left the building. The warning signs were drowned out by the roar of the crowd and the sudden arrival of high-level political intervention. Just as the momentum began to flag, 2 massive catalysts struck the market in back-to-back sessions. acting as jet fuel on a bonfire. The first came from the White House, and it fundamentally altered the global macro landscape. On Tuesday, January 27th, President Trump explicitly intervened in the currency markets, accelerating the decline of the US dollar with a few calculated sentences. When pressed by reporters on whether the greenback had fallen too far, the president responded with a nonchalance that sent shockwaves through the forex desks of New York and Tokyo. His assertion that the dollar was doing great in its devalued state was immediately interpreted as a formal policy shift toward competitive currency devaluation, a modern-day Plaza Accord designed to weaponize the exchange rate for manufacturing competitiveness. The dollar index collapsed to a session low of 95,566, its weakest point in 4 years. For precious metals traders, this removed the last remaining ceiling. The administration was effectively telling the market that it would tolerate and perhaps even encourage the debasement of the currency. Silver surged $7 that day alone, logging its largest single-day gain since the Hunt brothers era of 1980. The narrative shifted instantly from supply shortage to currency collapse, bringing a new class of fearful capital into the fray. The second catalyst arrived 24 hours later, cementing the bullish thesis in the minds of the speculators. On Wednesday, January 28th, the Federal Reserve concluded its two-day policy meeting. At 2:00 p.m. Eastern, the committee announced a vote of 10-2 to maintain the federal funds rate in a range of 3.5% to 3.75%, pausing after 3 consecutive cuts. While the statement removed language about labor market weakness, the market heard what it wanted to hear. During the press conference, Chairman Jerome Powell avoided committing to a tightening cycle, leaving the door ajar for future cuts if inflation cooled. In the fevered atmosphere of late January, a neutral hold was interpreted as dovish. The algorithm read the lack of hawkish commitment as a green light for inflation trades. Silver rallied another $6 in the illiquid after-hours trading session, breaking decisively above $115. The belief took hold that the Fed was trapped, unwilling to raise rates to defend the dollar for fear of crashing the economy, thus leaving hard assets as the only sanctuary. Beneath the headline prices, the dislocation in the physical market had reached absurd levels. By January 28th and 29th, the Shanghai silver premium had exploded to unprecedented heights. Chinese spot silver contracts were trading above $125 per ounce, a staggering $12 to $14 premium over New York prices. This was the market screaming that physical metal was unobtainable. Domestic buyers in China, eyeing the approaching Lunar New Year holiday and the week-long closure of the Shanghai Futures Exchange, were panic bidding to lock in supply. The arbitrage window remained welded shut by export controls and shipping bottlenecks. Traders in London watched helplessly as the spread widened, unable to move metal fast enough to capitalize on the discrepancy. This divergence fed the frenzy in New York, as Western traders convinced themselves that the U.S. price simply had to catch up to the Chinese reality. And then the retail mania arrived. It was the final, fatal ingredient. On January 26th and 27th, the iShares Silver Trust, SLV, recorded its largest single-day inflow in history, $171 million, nearly doubling the record set during the silver squeeze of 2021. Trading volume in the ETF surged to $40 billion, eclipsing Nvidia and Tesla, signaling a dramatic rotation of retail attention from technology stocks to tangible assets. This was not institutional rebalancing. This was the chaotic entry of the public. Data from Vonda Research indicated that retail silver buying was running at 11 times its normal rate, outpacing the AI trade. Social media platforms were flooded with screenshots of six-figure gains, fueled by a feedback loop of validation and greed. The Silver Squeeze 2.0 narrative went viral, with comparisons to GameStop dominating the discourse. The masses were piling into a momentum trade that had already gone vertical, oblivious to the fact that they were providing the exit liquidity for the very institutions that had bought at $70. The climax occurred on the morning of Thursday, January 29th. Silver opened Asian trading near $118 and surged to a new all-time high of $121.64 in the early New York hours, finally eclipsing the legendary 1980 high. The gold-silver ratio compressed to 46.79 to 1, the tightest since April 2011. Citigroup published a research note that morning, famously calling silver gold silver gold on steroids, and projecting a target of $150 within 3 months. For a brief, shining moment at 8:45 a.m. Eastern Time, the market felt invincible. The price represented a 272% gain year over year and a 65% gain in less than 30 days. Mining stocks like ECLA and Kerr were up 60% on the month. The euphoria was total. But in the shadows of this peak, the smart money was already gone. They had sold into the retail buying wave. The trap was set, the exit doors were locked, and the trigger for the slaughter was about to be pulled from a direction no one was watching. The turn came in the dead of night, while the retail bulls were still dreaming of $150. Overnight, the narrative shifted from a story of infinite demand to a brutal lesson in macro-political reality. On the evening of January 29th, the president teased an announcement regarding the future of the Federal Reserve, a seemingly routine piece of political theater that masked a profound regime change. Speculation had centered on Kevin Warsh, a former Fed governor known for his hawkish stance during the 2008 crisis and his skepticism of easy money policies. Betting markets had quietly assigned a 94% probability to his selection, but the algorithm-driven markets of 2026 required confirmation to reprice the world. At approximately 7 a.m. Eastern Time on Friday, January 30th, the confirmation arrived. In a post on Truth Social, the president officially nominated Warsh to succeed Jerome Powell, praising him as potentially one of the great Fed chairmen. The reaction was instantaneous and violent. The dollar spiked, bond yields exploded, and the pivot trade, the assumption that rates would stay low to support asset prices, died in seconds. The market realized that with Warsh, the era of rate cuts was over before it had truly begun. But while the political shock was hammering the front door of the market, a financial disaster was sneaking in through the back. The correlation between big tech and precious metals, usually tenuous, suddenly became a death pact. Microsoft reported earnings after the close on January 29th, delivering a report that shattered the invincibility of the AI trade. Despite beating revenue estimates, the company warned that its cloud division's growth was decelerating, while capital expenditures for artificial intelligence infrastructure were ballooning out of control. The stock plummeted 11% in pre-market trading on January 30th, its worst single-day decline in nearly 6 years. This was the spark that lit the fuse on a cross-asset liquidation event. The S&P 500 and NASDAQ futures began to buckle, dragging down the very hedge funds and family offices that had levered up to buy both technology stocks and silver. The correlation became one. The real mechanism of the crash, however, was not the news itself, but the leverage that lay beneath it. As the sun rose on Friday morning, a margin call cascade began to ripple through the plumbing of the financial system. Institutional funds that were long Nvidia and Microsoft on one side of the book and long silver futures on the other suddenly faced catastrophic losses in their equity portfolios. To meet the margin calls from their prime brokers, they didn't sell what they wanted to sell. They sold what they could sell. They sold the winner. Silver, which was sitting at record highs and offered deep liquidity, became the ATM for distressed funds desperately trying to plug holes in their tech positions. This forced selling hit a market that was already structurally weakened by a regulatory hammer blow delivered just hours earlier. At 6:00 p.m. Eastern Time on the evening of the 29th, the CME Group, the operator of the COMEX exchange, had announced an 18% increase in initial margin requirements for silver futures, effective immediately for the Friday session. This move was functionally identical to the infamous Silver Rule 7 employed in 1980 to break the Hunt brothers' corner on the market. It meant that for every standard 5,000-ounce contract, a trader now had to post an additional $10,000 to $15,000 in cash collateral. For the thousands of speculators who had bought in at $115 or $120 and were already underwater due to the overnight volatility, this was a death sentence. They did not have the cash. The only option was liquidation. The brokers knew it, and they acted with ruthless preservation. Owanda Japan slashed leverage limits by 75% overnight, effectively force closing thousands of retail positions before the market even opened. They weren't trying to save their clients. They were trying to save their own balance sheets from the inevitable wipeout. The carnage extended into the unregulated corners of the crypto market, where silver-linked derivatives and tokenized commodities were trading with leverage as high as 50. 1. As the price began to tick down in the pre-market, these positions were vaporized. Cryptocurrency exchanges reported over $750 million in liquidations in the early hours of Friday morning, removing a massive layer of speculative buy-side pressure just as the institutional selling wave was cresting. The setup for the opening bell was perfect and terrifying. You had a hawkish Fed pivot, a tech sector crash, a margin hike on the futures exchange, and a trapped retail public that had gone all in at the absolute top. The market was not just overbought. It was a pressurized canister waiting for a puncture. When the opening bell rang at 9:30 a.m. Eastern on Friday, January 30th, the floor didn't just drop out. It vanished. The opening of the New York session on Friday, January 30th was not a market event. It was a mechanical failure of the price discovery system. When the bell rang at 9:30 a.m., silver didn't just trade lower, it effectively teleported. Within hours, the metal collapsed from its overnight stability near $117 to an intraday low of $84.63. This 31% implosion represented the single worst daily decline since the Hunt brothers crisis 46 years earlier. In the chaotic vacuum of liquidity, Some intraday data feeds captured wicks, momentary price prints, as low as 73.86, evidence that for brief seconds, there were simply no buyers in existence. Algorithms that had relentlessly chased momentum on the way up were now programmed to amplify the destruction on the way down, triggering a cascade of stop-loss orders that hit the order book like a series of demolition charges. The crash was indiscriminate. It wiped out the late retail buyers who had entered above $100, but it also destroyed the prudent traders who had set tight stops. It was a liquidation event that cleared the board, resetting the psychological state of the market from euphoria to trauma in less than 6 hours. But the devastation was not confined to the digital screens of Wall Street. The shockwaves traveled instantaneously to the physical hubs of the global trade, nowhere more destructively than in Rajkot, India. As the price plummeted in New York, a catastrophe of biblical proportions began to unfold in the narrow streets of one of the world's primary silver trading centers. Between January 30th and 31st, 44 major trading firms in Rajkot declared insolvency, unable to settle liabilities totaling 3,500 crore rupees, approximately $420 million. The structural cause of this collapse was the failure of the Volan trade, the local arbitrage practice where traders sold silver short, betting that prices would stabilize or revert. These firms had operated with supreme confidence that silver would never breach the 125,000 rupee per kilogram threshold, roughly equivalent to $150 per ounce, when the global price exploded past that level in the final week of January, and then violently reversed. The volatility destroyed both sides of their book. They were squeezed on the way up and liquidated on the way down. By Saturday night, January 31st, an emergency meeting was convened in Rajkot. It was a surrender. The 44 firms admitted they could not pay. Some traders shuttered their shops and fled the city, leaving counterparties across Ahmedabad, Indore, and Dubai staring at balance sheets filled with toxic debt. Local political leaders suggested the true losses were closer to $1.2 billion, a figure that threatened to paralyze the regional economy. This contagion illustrated a critical lesson that the charts in New York could not show. The January volatility didn't just hurt the bulls who bought the top, it annihilated the bears who had shorted the rally, thinking it was unsustainable. It was a widowmaker move, a dual-edged sword that severed the capital of anyone who dared to use leverage, regardless of their directional bias. When the dust finally settled and silver closed the month on January 31st at 85.23, the statistics presented a paradox. The metal had finished up 18.77% for the month, a spectacular return by any standard metric. Yet the psychological reality was that of a crash. The history books would record a gain, but the survivors felt only the pain of the 31% intraday collapse. Now, the market turns its gaze to February, and the forensic evidence points to a treacherous path ahead. The monthly candle for January closed as a textbook shooting star, a technical pattern characterized by a small, real body near the opening price, and a massive upper wick representing the rejection of higher prices. When this pattern appears after a parabolic rally, it is historically a signal of exhaustion and impending consolidation. The market has effectively proven that it accepts $85 but violently rejects $120. This establishes the battlefield for the coming weeks. The support levels to watch are critical. The $80 to $85 zone, which held during the crash, is now the line in the sand. Below that lies $75 to $78, the 50% Fibonacci retracement of the entire January move. A loss of the $70 to $72 level would signal that the bull market is structurally broken. On the upside, resistance is formidable. The psychological zones of $95 to $100 will be defended by this bag holders, traders who bought the top and are desperate to sell at break-even. Reclaiming $100 is the only thing that can restore bullish momentum, while the all-time high of $121.64 is likely a bridge too far for the immediate future. The seasonal headwinds for February add another layer of danger. Historical data is unequivocal. February is a kill zone for precious metals. Over the last 10 years, short positions in silver during this month have been profitable 80% of the time. The metal has declined in February in 7 of the last 8 years. This seasonal weakness is driven by a convergence of factors: post-January profit-taking, the absence of Chinese buyers during the Lunar New Year, and reduced industrial fabrication demand in the Northern Hemisphere winter. The Shanghai Futures Exchange will be closed from February 16th to the 23rd, removing the primary driver of physical demand from the global equation for a full week. Without the relentless bid from China, the Western paper market is left vulnerable to bearish predation. Furthermore, the macro environment has shifted. With Kevin Warsh's nomination, the Fed put is gone. The market must now price silver not as a hedge against a debased dollar, but as a volatile asset in a higher for longer interest rate regime. The investment community is now split into two warring camps regarding the trajectory of the next 30 days. The bullish case, championed by veteran traders who correctly predicted the crash, argues for a dead cat bounce. They believe the sell-off was too fast and too deep, creating oversold conditions that must be relieved by a rally back toward $95 before any further decline. Citigroup has maintained its longer-term structural targets, citing the immutable reality of the 200 million-ounce supply deficit. The bearish case, however, is darker. Analysts at Bank of America and frantic voices from the value investing world argue that the price is still detached from reality. They see a mean reversion to the $60 or $70 range as necessary to flush out the remaining speculative froth. They point to the crowded trade dynamic, noting that despite the liquidation, open interest remains elevated. There are still too many tourists in the market, and the market has a cruel tendency to punish the majority. The conclusion is inescapable. The easy money has been made and lost. February is not a time for heroism. It is a time for survival. The volatility of January was a siren song that lured in the greedy and punished the reckless. What remains is a market that requires surgical precision. The strategy for the coming month is one of accumulation, not speculation. It is a time to build positions in the trenches, waiting for the price to come to the buyer rather than chasing the green candles. The tourists have been washed out. The weak hands have folded. What is left is the volatile two-way market that precious metals veterans know well. The structural deficit has not changed. China's export ban has not been lifted. The vaults are still emptying. But the price must now consolidate, digest the trauma, and build a base for the next leg. For those with conviction and capital, the crash of January 30th was not an end, but a beginning, a violent reset that offered the opportunity of the decade for those brave enough to step into the blood. The trap was sprung, the damage is done, and now the real work begins.